Hello everyone and welcome to Triffin's lunchtime session. I'm Tash Courtenay-Smith and I'm super excited to be joined today, and I know you guys are super excited to be joined today, by Ian Cruickshank, who is the VP of Product at Triffin. Ian is also the man who knows everything about... Ian, what do you know everything about?
I wouldn't say I know everything about, but I know enough to be dangerous, I suppose.
He said it himself. He knows enough to be dangerous about
consumer brand finance, what the journey entails on that kind of road from 1 to 10 million on a brand's journey, from the accountant's perspective, from the finance person's perspective, and lately a little bit from the product and tech perspective.
Fantastic. Okay, well, we're going to be talking about how brands can break through, particularly going from 1 million to the 5 million mark. And we're going to be talking about that by talking about some of the things we see that brands get wrong, which is probably the best way to address these issues. But why don't we kick off and you tell our audience today a bit about who you are and some of the past experience you've had in finance and e-commerce.
Absolutely. So my background is as a Canadian CA. Started my journey in a startup out of university that was doing bookkeeping for small businesses across Canada and the US, and it was growing super quickly. It kind of enamored me with the small business mindset and the problems that people go through trying to grow a business, and how hard and how kind of brave you have to be to start a small business. Mm-hmm. Super impressive. But then kind of went off and worked for KPMG for 3 years. Got my chartered accountant's designation, saw what some of the big companies in the world look like and all the things that you should kind of aspire to do in your business that can technically be the boring stuff, but really when you tick all those boxes, you create some sanity in your life, and you should strive to do that in growing your small business. But definitely missed the excitement of startups, so went back to that world as a financial controller, and then eventually a finance director of several tech brands that raised venture capital, and went through that kind of journey of rapid growth, mm-hmm. and then right sizing, and then back to rapid growth and all the excitement that entailed, and kind of craziness. And then finally landed with a company called Fable that some friends of mine had started as their finance directors. They raised venture capital and grew an e-commerce brand from sort of 2 or 3 million a year to up to $20 million a year in the space of kind of 2.5 years, which was an incredible journey. Wow,
incredible.
Yeah, it was I learned a lot. It was a lot of lessons learned along the way, and it was done at a time when consumer brands were growing like crazy. So it was a kind of drinking from the fire hose experience for sure.
Fantastic. So let's start with a question of growth first, then, because you've been at a very fast growth brand that did that in 2 years, or profit first. And that's the question. I mean, you and I, we have to fess up. We work with some of the same brands together, and we work with a lot of different brands separately. You're working across 20 brands, and I work across a number of brands. They all essentially say the same things, don't they? They ask the same questions and face the same challenges. One of those questions is around, are we growing top line revenue, or are we looking for profit here? What's your view on that?
I think that the kind of first 3 years of the 2020s was definitely focused on top line growth, mm-hmm. and it was a time of crazy opportunity with everything that kind of COVID brought and the stay-at-home wave. And there was a lot of money put into a lot of brands, and capital was available from every source. So top line growth was the metric to face, mm-hmm. And pursue. And on the back end of that, we saw what happened when everyone went back to normal life, and the reality of top line growth and the cost that comes with it landed really heavily in sort of 2023. And there was a complete sea change in the industry on what it meant and how you were going to grow your brand and what was the options available to you. So as an accountant, I'm typically kind of a conservative person, some might say, to a fault. But, I think if you build your business from a point of profitability and focusing on sort of simplifying your business into a average kind of order, your average customer, and understanding how for the kind of 80% of your customers, if you're profitable on them, mm-hmm. you've built yourself a business that can sustain itself and it can grow. You can make mistakes and it's not going to put you under. So I think for me, top line revenue growth was always great. It's exciting, and certainly comes with a lot more stress and a lot more.
I mean, you've been in that
excitement.
world of driving for top line revenue growth, haven't you?
Absolutely, yeah. We were going for 300% growth year over year in an e-commerce business, which we achieved and had sort of the tailwinds to do so at the time. But it certainly is a lot more stressful. The mistakes can cost a lot more, and your risk profile is much higher. So I think every founder kind of has to ask themselves the question of, do you want to take that experience, and do you have the ability to probably go obtain the capital to fund that experience? Because for your average brand, that isn't really an option to grow at that rate unless you have a crazy product or a crazy opportunity in terms of access to a market and people's attention. So unless you have some crazy virality or something like that, you kind of have to build a business the old-fashioned way these days.
How do you find founders react to that nowadays? Because a lot of people in e-commerce have either been in that previous period or heard the great stories of success from that previous period. How do you find founders are reacting now to that concept? Are they actually relieved that they can build something sustainable, or are they resistant to are they wanting that fast growth, amazing runaway success story?
I think everybody wants that at the end of the day. But I would say across the people I've dealt with, I see all kinds. There's some people are, we're always happy to kind of take the steady path, build things on a fundamentals basis, and they see success over the longer term. And I think there's a lot to be said about that. And patience is the main kind of asset you have to have. And it can definitely work out. On the flip side of that, I think that the being a founder and how much risk is required to build a brand, I think that's where sort of the conservative accountant part of me, I've gotten better over time of putting that kind of side of myself in its place, and you have to take a risk. That's how you build a business. So you kind of have to have that North Star you're chasing. And I think to build a business, even if it's growing steadily, you got to have a little bit of that in you to get your brand on the way to growth. Otherwise you wouldn't take the risks.
So when you first look at a brand and, you'll get its P&L, what's the first thing you're looking for in terms of thinking, what state is this brand in? Where is this brand at? Where do you go to first?
I think for me, assuming that the numbers are right, and that's saying a lot for brands in that 1 to 10 million space, is the numbers are often behind and they're very late, and it's hard to steer a brand on that. It's not, finance and administration isn't something that most founders care about until it's too late. And so if you focus on it early and kind of ingrain that in the way you steer your business early, I think it leads to a lot better success, because you're not going to be surprised when things go wrong. But I think assuming kind of the numbers are right, the first thing I look at is your month-to-month net profit, and you look at the back 12 months. So you want to see what the shape of a business looks like. Every business has some element of seasonality to it. Is it something that sells well in the summer? Is it something that sells well around the holidays? Is it a big Black Friday, Cyber Monday business? What's the shape of the business look like in terms of seasonality and in terms of profitability? And when you put that all together and smush it into a year, are they profitable on a yearly basis? That's the first thing I look at. The next thing I look at is, put all the costs together that they take to acquire a customer. The ad spend, the paid placements on an above the line, influencer and affiliate costs, all of the supporting agency fees that they use to put their ads out there in the world or generate their content or the branding. And you look at how many customers show up each month for what they're spending, so that I can understand that how much they are really paying to acquire customers. What's that look like at different times of the year? And how does that compare to what that kind of first-time customer buys? So you have to kind of very quickly shift away from just the P&L, and you need to merge some information from the P&L with information from your sales system. And then you can split it up as many ways as you want from there. But at a whole, I want to know how many new customers showed up a month, how much you spent to acquire them, and then you can understand, okay, well, how dependable are my returning customers, and is there a business that's generating cash here?
So what's interesting about that calculation that you've just talked about, and in a minute we're going to come on to the things brands often get wrong, which we're calling the silent killers, but this is a really important point that I know will land with loads of the people watching, which is you have put agency, content production and all costs into what you're calling a kind of cost of acquisition there. It's become the industry norm over years to just have ad spend against new customers as the cost of acquisition, and it's much debated. I think we can understand why agencies do that because they don't necessarily have access to the overall costs in the business. But from a brand's point of view, brand side, you're saying absolutely all those costs, including agency fees, go into your cost of acquisition.
Yeah, agency fees, even the content costs. What's it cost you to do a shoot and then get that into your ad stack and into what's the content that's being advertised?
Yeah.
You really have to look at it at a complete picture. There's no use in vanity metrics when you're trying to grow a business yourself. For the average brand, capital isn't available the way it was 3 years ago. So you've got to kind of squeeze every pound or every dollar into something that makes sense for you in acquiring your customers. And you need to know exactly how much that costs on a month and whether you're getting the return on investment in creating that content or creating that.
And do you think most brands know that? If you were to say, talk to the average brand that's doing 5 million in revenue, will they know that, including all those costs typically?
I think at the space of 5 million, you definitely should. You kind of have to at that point. I think if you're under that, it's a bit, I would say your average person doesn't, especially month to month. You haven't really thought about probably the seasonality of when it occurs. They're just kind of looking at cash in the bank account each month. Is it going up? Is it going down?
Yeah.
But there's so many variables into that. They haven't really kind of started to think about it from a finance perspective. Usually when you're doing, sub $1 million or $2 million a year.
And if a brand puts all those costs together and suddenly realizes, my goodness, when I put in the content costs, the agency costs, all these costs, my CAC is way higher than I thought it was which is obviously going to be the case. What's your advice for them?
I think in that case, you kind of have to look at it and say, well, did my investment in the first month pay off? So that first time I'm a new customer, or, take a handful of the customers that you acquired in a month.
Yeah.
And look at how their behavior has been over time. And that will inform you, are you making a good investment in a monthly basis is a reasonable month to a reasonable time period to look at. But, within 3 months, within 6 months, have those customers come back and purchase from you a second time, a third time, a fourth time, and have those sales now made that investment in marketing activities pay off? And if the answer to that question is no, or you're unable to kind of answer that question, then I'd say you have a real risk in your business that your investments are just going to be burning whatever capital you have on hand in marketing. So I think it's a critical question to ask yourself of, do you have a viable business there?
Oh, that's a brutal question. Hopefully everyone watching this will be answering, yes, they do have a viable business. So let's come on to the silent killers, because actually the first one is one that directly relates to what you're saying, which is the CAC against LTV, but not from a vanity point of view. We're not talking about just like, oh, my CAC on Meta's this and my LTV on, whatever app we're using is this. You're talking about at a core business level. So what are some of the challenges you see around that?
I think one of the core challenges around that question is there's a lot of data involved in that. And for your average, non-technical person or kind of finance spreadsheet wizard, you have to then tie together tons of information to get yourself a picture. So you need to look at one customer and then find all of the subsequent orders that customer has made and tie together what that customer ordered and what each item they ordered cost and what it cost to ship those things to that customer, or whether they bought in retail. And all of a sudden you're looking at doing a calculation on a single customer basis, and you've got 30 points of information. So that's really difficult to do unless you have a system to do it easily, or you've got a lot of time on your hands. And for your average founder, or small brand kind of business, everyone's plate is 3 or 4 times overflowing. So taking the time to do that is often a exercise that gets missed, or exercise that no one's had the time or availability to do. So I think that's what makes it so difficult, but so important in my view, is to really understand what your average customer does every month. So you should look at it every month or every 2 months of what have 10 people that purchased from me 3 months ago done since then.
I have to say, one of the things I love about working with Triffin is, obviously we all know everyone in performance and e-commerce gets totally tied in knots about attribution and what's doing what and which channel's doing what. And when you're also working with Triffin and all the platforms, you can just see it at a business level. And it actually solves a load of problems just to be able to look at it from a business point of view in terms of number of customers, actual cost of acquisition. Is the business profitable or not?
Absolutely, yeah. That's what we've kind of built Triffin around, is the fact that there's a lot of data sources. Everyone says something kind of different.
Everyone's saying something different, aren't they?
Yeah.
But the P&L doesn't. The P&L is the P&L.
The P&L doesn't, Shopify when you put the right numbers in the right place.
Yeah.
And Amazon when you put the numbers in the right place, and then tying that all together in one place. When all that's there, there's really no lying. There's no kind of escaping the truth. There's a certain number of new customers came.
Yeah.
A certain number of old customers came. They ordered some things. All of that had a cost, and he paid a logistics company most of the time to get that to them. And we've built the platform to answer that question, essentially, because then, well, really you can sleep at night, sort of knowing that, you made the right investment in marketing, or the investment that you're making in the activities, the overheads of your business are generating profit for you, because otherwise you don't really have a business, unfortunately.
What about product level profitability and decisions people take around products? You can have products that are selling really well and people put a lot of focus into them, and then you get into it and you're like, well, these are not particularly, good products from a profitability point of view.
Yeah, I think it's a really difficult problem for small brands, especially, is that you can market your way to growth, and that's one thing. But really, one of the other main viable ways to grow your business is to broaden your product portfolio and offer your existing customers new products, or finding new customers who maybe didn't like your original product, but they'd like another one. Mm-hmm. So there's always the pull to continually widen and broaden the product spectrum, especially with a focus on growth. I think the other really difficult problem that you really have to ask yourself is, when you create a new product, you generally have to go find a supplier that will only produce that product in a minimum order quantity, and you have to take that risk that you're going to have customers that will come and buy that product at volumes that, don't have that product sitting on your shelf for 12 months after you've bought it. You don't want to be tying up cash for that long as a small business. For most D2C and e-commerce businesses, you want to kind of turn through your inventory every 3 months, essentially. So if you put an order in with a supplier, if it's sitting there in your warehouse for 12 months, you've ordered too much. And sometimes the reality is that you couldn't buy in small enough quantities from your supplier, or buy in prices that make enough sense for what you can sell it for in terms of margin. But essentially, when you're building a business, and especially at that smaller stage of sub 5 million, you really need to know what your hero products are, and you really need to nail your supply chain and ordering cycle so that you have good payment terms with your suppliers, so that you don't have cash tied up for 6 or 8 or 12 months.
And where's the 3-month number come from?
It's a sort of a best practice. Like if you look at really, really large companies and you have working capital. So your working capital is your assets, essentially, minus your short-term liabilities. And so that's your cash, your inventory, your accounts receivable, less your accounts payable, and so forth. But as a really big company, they will hold 3 to 6 months inventory on hand. So you want a little bit of buffer in case your sales increase really quickly. And you need some buffer in case you don't have another the world's pretty crazy these days. There's a lot going on, and there's a lot that's happened over the last kind of 4 or 5 years in terms of events that we faced at the companies I was with. But, there was the Ever Given thing where inventory was tied up by the Suez Canal being blocked. There's the Port of LA strikes that, blocked massive amounts of inventory going through North America. Like those are, I think, when you start a D2C business and you're buying from around the world, if your suppliers are in countries around the world, which is changing a lot these days, you had to get really knowledgeable about world events really quickly.
I know, my God. Sometimes I feel so bad for the founders and all these things that happen that you never could have imagined, like the Suez Canal thing.
Yeah, and that's really around where you're kind of getting to of, you want to have 3 to 6 months of inventory on hand. And what you want to do is be constantly checking, what's my turnover of inventory rate? How many units do I have on today? How many did I sell last month? That gives you your turnover ratio of inventory. That's something you want to have 3 to 6 months on hand. For some, small businesses, they're constrained by how long it takes for their inventory to get to them. Maybe it takes 2 months to put the inventory on a boat from China and get it over to the UK. And your supplier will only make so many units of it at a time. So you can only order a year's worth of inventory at a time. And that's inherently just a really risky business to be in. So something to think about is, unless you're a really well-capitalized business, that might not be a product that you want to get into until, you're profitable and have cash on hand, or you have debt facilities that will allow you to fund that inventory purchase and spread those repayments over a long term or in the future. So all of this sounds super complicated because it is.
I mean, it is super complicated. And also some of it comes down to kind of personal preference and access to capital. So talking about risk, what do you say, or what do you think when founders, and there'll be some people probably watching this now who would think this is, who would absolutely be taking the strategy of, we're growing fast, we don't mind losing money. And there'll be other people who are watching this who will say, well, we would never want to grow fast at the cost of losing money. Some of that is personal preference and appetite for risk, isn't it? It's not necessarily right or wrong. How do you answer questions like that? And what do you say to founders when they say those sorts of things?
I think it's being, I think a lot of founders, like you said, you have to be risk loving to a degree. You have to take risks to grow a business. It's kind of the nature of the beast. But I think sometimes you need to take a step back and put all the pieces together in a simplified way, though. Like, think about it logically and say, okay, am I losing money to acquire customers because I think I'm growing really quickly and I know they're going to come back and buy from me a lot, So that's one piece of information in itself. And then you say, okay, well, I've got a really great relationship with my supplier. I can order a month's worth of inventory at a time and it'll be in my warehouse in a week. And I've got 30-day payment terms there. That's, another kind of piece of information about your supply chain that you put together. And you say, okay, well, I don't have to order too much. If I say, get my customer acquisition wrong and maybe people don't show up the way I thought they were going to repeatedly, that means I don't have to order more inventory and I'm not putting myself in a hole where I'm acquiring customers unprofitably. I've bought a whole bunch of inventory to sell to them that I know I'm not going to sell now.
And then you're in a downward spiral.
And then you're in a doom spiral, essentially.
Yeah.
So I think it's about really putting together the pieces of your business all together. That is what you need to do, is you need to kind of take a look at it, take a step back, put it down on paper, understand what your whole kind of supply chain through customer acquisition kind of journey looks like, and say to yourself, does this make sense? Is this going to work out? And it's a complicated question, but unless you can kind of answer that, you're not really you're at risk of not being in control of your business for sure. I think so depending how much risk you want to take, which is again a personal preference, I would say, look at your supply chain, look at your situation, and are you set up to grow really aggressively? Or do you have super long lead times? Do you have to order a year's worth of stock at a time that's going to take an extra 2 months to get to you? So that means you need to go put a huge amount of cash out into the world and wait a long time for it to come back to you. You want to be really, really certain that you're going to sell that. That's not a situation where you should be acquiring customers unprofitably, and spending a ton on marketing and burning cash from a P&L perspective, because
you're just increasing your risk of a doom spiral, essentially.
You're increasing your risk of a doom spiral, essentially, yeah.
I mean, brands say to me all the time about you, what does Ian think? Like, what does Ian say is good? And I'm sure they ask you the same question, don't they? Like, what's good? So they'll say, what does Ian say about this metric or that metric? And, can you ask Ian what this metric should look like? And I'm always like, well, I can ask Ian, yes, of course. But they're all different scenarios, aren't they? With, as we've covered today, a huge number of moving parts.
Yeah.
What metrics do you think people should be focusing on? And can you tell them what's good?
I think...
3 months to turn around stock is a clear metric that's good, isn't it?
Yeah, I think you want to hold 3 to 6 months of any given SKU on hand. And, if you're constrained around things that don't allow that to happen, then you want to be really certain that you're going to sell it. Or perhaps you don't have, maybe you're pretty thinly capitalized, you don't have a bunch of cash in the bank. I think, you probably want to think about foregoing that opportunity. I think in terms of overall P&L management, it's a number that I like to kind of stick by, and as something I've talked to, VCs in board meetings when they, are inputting their view into budgets. People are talking about you don't really want to spend more than 30% of your revenue in total on sales and marketing. Mm-hmm. That's if you look at a P&L, you've got your revenue, you've got your gross margin. The kind of word in D2C is that you want to have at least a 60% margin, and that's your gross profit margin. So that's after.
And do you think that's good?
I think it's manageable. Yeah, I think
it's not great, is it?
I think 60 is good. Yeah.
Okay.
Again, then it gets complicated because you split it down into channels, and there's probably different benchmarks for different channels.
Yeah.
Like I think a 60% gross profit margin in a wholesale channel is really difficult to maintain, but for D2C specifically, you definitely want 60%.
Yeah. Or higher.
Or higher. And why is that? Because it's going to cost you at least probably 5 or 10% to ship it to a customer. Your product cost should be anywhere from sort of 10 to 20%. And then you're going to have some returns and discounts and other things that kind of hammer that margin. But if you set yourself a benchmark of 60%, that leaves you a lot of headroom to do the other things your business needs to do. So if you're spending 60%, if you have a 60% gross profit margin, so your cost of sales is 40%, that means that you've got a maximum, in my view, of sort of spending 30% on sales and marketing activities. So you had a 60% gross profit margin. You've now spent 30% on acquiring new customers and getting your old customers to come back. So that means you have 30% contribution margin, which is a good benchmark to work from. Most people, you're going to have the fixed costs of your business and the overheads to run your business. You need to pay lawyers and tax accountants and your staff and yourself, and have a bunch of subscriptions that it costs to run any kind of business these days. So you probably want to budget another 20% for that. That would leave you with a net profit of 10%. And that's a very, very simplified view of what a business's P&L should look like or could look like. But that's a good benchmark. So when I go into like a budgeting exercise with a business over a year, that's some pretty rough frameworks. Like if we start with a revenue target, which is usually the way we go about planning something, you figure out how many customers are going to come back and buy from you this year, and you figure out how many new customers you think you can go acquire this year based on trends and stuff. That sort of gives you a revenue number to start from. And then you kind of budget everything else down from there. But that's how you start and you get to a budget number. And whether reality pans out that way, it's different, but it's a good way to set some yardsticks. Rather like, I think it's always really important to know, like any sort of scientific test, you have to have a hypothesis at least, and you got to set a line in the sand of what you're willing to spend should everything go perfectly, and then you need to be nimble enough to change when things aren't going to plan, or if they're going better than planned, then you reforecast and you can redo the whole exercise and, invest more if things are going well. Because I think, not to sound all doom and gloomy, you certainly see a lot of brands these days still that are growing like crazy. And
Yeah.
the answer is, you're not spending enough money. Like, you've got a great opportunity here. Spend more, talk to a wider audience, get more attention, do what you need to do those activities, because your business has the fundamentals to grow really quickly. And we certainly see that as well.
I know. And actually, just to say before we wrap up, because we've run out of time, I've heard you say that as well when a brand's going well. So that's why I think people really like working with you and having your brain on their numbers, because it's reasonable. If things are not tense, you're the first person to say, and if it's going well, equally, you're the person that says, well, look, this is all stacking up. Go for it.
Yeah, absolutely. I think, and in my journey is, growing as a professional, and I think as a, younger person, you don't want to tell someone the bad news, but it's better I've learned, when you don't tell people the bad news, bad things happen.
Yeah, and I think it's great to tell people the truth, and that's what people appreciate when they're working with Triffin and when they're working with you as well.
Yeah, I hope so. That's what we aim to do.
Yeah.
I think it's hard, and I think, as a finance professional, you have to learn to kind of balance the good with the bad and deliver, because there's a personal side to delivering that news. Like, you can't just say, you don't have a business, this isn't working, but that's the message you need to deliver. But people are under a lot of stress often, and so we try to find the best way to communicate when things are going poorly and communicate when things are going well. I see all kinds of cases, and I had, like you said, I had a conversation with someone the other day. I said, hey, I've seen these metrics on this channel, this product, should I double my money and put into that? And the answer was like, absolutely. And sales have doubled over the last month. So it's about understanding your metrics and understanding your business in kind of terms of like, is this working? Then you can go chuck the kind of whole bucket at it and see, hope you grow like crazy, because it definitely happens.
Brilliant. Well, we're at the end of today's session, but thank you so much, Ian. That was brilliant. And I hope everyone watching found it super useful. Obviously, people can get in contact with you and Triffin by getting in contact with Triffin.
Absolutely.
Brilliant. Thank you so much,
Thanks,
Ian.
Tash.
Thanks.